Imagine Maya, a young woman in her early 20s, always struggled with her finances. She worked hard but never seemed to get ahead. One day, she decided to change her approach to money and started adopting new investing habits. Fast forward 10 years, and Maya's life has completely turned around. She now enjoys financial freedom and is well on her way to building lasting wealth. How did she do it? The secret lies in her disciplined investing habits. Investing can seem intimidating, especially if you're just starting out. Many people think they need a lot of money to begin, but that's not true. By adopting certain habits, anyone can grow their wealth faster and more efficiently. These habits are simple yet powerful, and they have the potential to transform your financial future. In this video, we'll explore 7 investing habits that can change your life. From starting early to keeping emotions in check, these strategies are designed to help you build wealth steadily and securely. Whether you're a seasoned investor or a complete beginner, these habits can guide you toward financial success. Ready to take control of your financial future? Let's dive in and discover how these habits can work for you. Habit 1. Start early and stay consistent. Meet Tom. When Tom was 22, he decided to start investing a small part of his paycheck every month. He didn't invest much, just $100 each month, but he did it consistently. By the time Tom was 40, his investments had grown significantly thanks to the magic of compound interest. Compound interest means you earn money on both what you initially invested and on the interest that money earns over time. Starting early gives your money more time to grow. Even small amounts can become big over many years. The key is to be consistent. Just like Tom, if you invest a little bit regularly, it adds up. You don't need a lot of money to start investing. The important thing is to start now and keep going. If you start investing early and stay consistent, you give your investments more time to grow. This can help you build wealth faster and reach your financial goals. Don't wait for the perfect moment or a large sum of money. Begin with what you have and watch your money grow over time. Remember, the sooner you start, the better off you'll be. Habit 2. Diversify your portfolio. Imagine Jane, who invested all her money in one company's stock. At first, the stock did well, and Jane was happy. But then, the company faced problems and the stock's value dropped drastically. Jane lost a lot of money because she didn't diversify her investments. Diversifying means spreading your money across different types of investments. Instead of putting all your money in one place, you put it in various stocks, bonds, real estate, and other assets. This way, if one investment does poorly, the others can help balance out the loss. Diversifying your portfolio helps manage risk. It's like not putting all your eggs in one basket. If one basket falls, you still have eggs in other baskets. This strategy can protect your money and make your investments more stable. To diversify, you don't need to be an expert. You can start with simple steps like investing in index funds or mutual funds, which automatically spread your money across many investments. You can also use apps or services that help you diversify easily. Remember, a diversified portfolio can help you grow your wealth steadily while reducing risk. It's a smart habit that every investor should adopt. Start diversifying today to build a stronger, more resilient financial future. Habit 3. Educate yourself continuously. Educating yourself about investing is very important. The more you know, the better choices you can make. Understanding how the market works, learning about different types of investments, and staying updated with the latest financial news can help you avoid mistakes and spot opportunities. You don't need to become an expert overnight. Start small. Read a book or article about investing. Watch videos or take online courses. Follow reliable financial news sources. The more you learn, the more confident you will become in making investment decisions. Continuous education helps you stay ahead. Markets change, new investment products come out, and global events can affect your investments. By keeping yourself informed, you can adapt and make smart moves. Remember, investing is a journey. Keep learning and improving your knowledge. It will pay off in the long run, helping you build and protect your wealth. Habit 4. Automate your investments. Automating your investments means setting up a system where money is regularly invested without you having to think about it. This habit ensures you invest consistently and avoid the temptation to spend the money elsewhere. Automating is easy and convenient. Most banks and investment platforms offer automatic transfer services. You can decide how much money you want to invest and how often. Once it's set up, it runs on its own. This way, you're consistently putting money into your investments, helping them grow over time. Automating your investments also helps reduce emotional decisions. When the market is up or down, it's easy to get caught up in the moment and make impulsive choices. By automating, you stick to your plan regardless of market fluctuations. Start automating your investments today. It's a simple, effective habit that can help you build wealth steadily and reduce stress. Set it and forget it, and watch your money grow automatically. Habit 5. Keep emotions in check. Investing can be an emotional roller coaster. When the market goes up, it's easy to get excited and buy more. When it goes down, fear can push you to sell. However, making investment decisions based on emotions can lead to mistakes. Keeping your emotions in check means staying calm and sticking to your plan, no matter what the market does. It's important to remember that markets naturally go up and down. Panicking during downturns or getting too excited during booms can hurt your long-term goals. One way to manage emotions is to have a clear investment plan. Set your goals, decide how much risk you're comfortable with, and stick to your strategy. Avoid checking your investments too frequently, as this can lead to impulsive decisions. Another tip is to remind yourself of your long-term goals. Investing is a marathon, not a sprint. Focus on the big picture and avoid reacting to short-term market movements. By keeping your emotions in check, you can make better investment decisions and stay on track to build lasting wealth. Habit 6. Regularly review and rebalance. Reviewing your investments means checking how they are performing and whether they still match your goals and risk tolerance. Rebalancing involves adjusting your investments to maintain the right balance. For example, if one type of investment grows faster than others, you might sell some of it and buy more of the slower-growing ones to keep your portfolio balanced. Regularly reviewing and rebalancing your portfolio helps manage risk and ensures you stay aligned with your investment strategy. It prevents any single investment from becoming too large a part of your portfolio, which can be risky. You don't need to do this too often. Reviewing and rebalancing once or twice a year is usually enough. Use this time to check if your goals have changed and adjust your investments accordingly. By making regular reviews and rebalancing a habit, you can keep your portfolio healthy and growing steadily. It's a simple yet powerful way to stay on track with your financial journey. Habit 7. Take advantage of tax-advantaged accounts. Tax-advantaged accounts are special savings accounts that offer tax benefits. Examples include 401k plans, IRAs, and Roth IRAs. When you invest in these accounts, you can save on taxes either now or in the future. This means more of your money can grow over time. A 401k is usually offered by employers and lets you invest part of your paycheck before taxes are taken out. An IRA is an individual retirement account that you can open on your own. With a Roth IRA, you invest money that's already been taxed, but you won't pay taxes on it again when you withdraw it in retirement. Using these accounts can significantly boost your savings. Make sure to contribute as much as you can, especially if your employer offers matching contributions for your 401k. This is like getting free money to invest. By taking advantage of tax-advantaged accounts, you can save more efficiently and grow your wealth faster. Start using these accounts today to secure a better financial future. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to the channel to see more content like this. Thanks for watching, and I'll see you in the next video.